Most traders think trading the news is nothing more than gambling. They see the spike, the whipsaw, the sudden candle that wipes out positions in seconds. They watch price explode after NFP or CPI and say, "That's just luck." They call it manipulation. They blame algorithms. They swear the market makers already knew the number before it dropped. And after a few painful losses during high volatility, they decide news trading is a casino. Meanwhile, a small group of traders wait for those exact moments. They don't fear the volatility. They prepare for it. They don't guess the number. They don't chase the first candle. They don't double their lot size hoping to catch the move of the month. Same economic calendar, same release time, same data, same charts. So why do some traders grow their accounts during news events, while others destroy months of progress in 5 minutes? It's not about being faster. It's not about having insider access. It's not about expensive software or secret feeds. And it's definitely not about predicting the headline before it hits the screen. The difference is much simpler and much harder to accept. Most traders approach the news emotionally. A few approach it structurally. And that single shift is what separates gambling from disciplined execution. Today, we're going to break down why trading the news feels like luck, why most traders handle volatility the wrong way, and how structured traders use these events to prove that it was never luck to begin with. Part 2. 2 traders, 1 news release. Let's look at what actually happens when the number drops. Imagine it's non-farm payrolls. The countdown is ticking. Spreads start widening. The market goes quiet for a moment, like it's holding its breath. Every trader watching knows volatility is coming. Same time, same release, same anticipation. But what happens next depends entirely on who you are as a trader. James is already in a position 5 minutes before the release. He read a few opinions online. One analyst said the number would miss expectations. Another hinted at a surprise beat. James picks a direction based on what makes sense. He increases his lot size because this is where the real money is made. He doesn't want to miss it. The number hits. Price explodes in the opposite direction. His stop gets slipped. He panics. He closes early. Then price reverses violently. Now he's frustrated. He jumps back in. Another spike, another loss. Within minutes, weeks of steady gains are gone. He leans back in his chair and says, "News trading is just luck." Now look at Daniel. Same release, same chart. But Daniel isn't in a trade before the number. He has levels marked from higher time frames. He knows where liquidity likely sits. He already decided how much he's willing to risk, and it's smaller than his normal size. He expects spreads to widen. He expects chaos. When the number drops, he doesn't react to the first candle. He watches the reaction. He waits for structure to form, a pullback into a predefined zone, confirmation. Then he executes. Stop placed, risk defined, no emotion. Sometimes he wins, sometimes he loses. But over months of trading similar events, his results are consistent. Same news, completely different outcome. This is where most traders get it wrong. They think news trading is about predicting the number. It isn't. Professionals aren't trying to guess whether CPI prints hot or cold. They understand something far more important. News events are volatility injections. They are scheduled moments where uncertainty becomes visible. Liquidity shifts. Order flow accelerates. Emotional traders lose control. Structured traders stay calm. The problem is not the news itself. The problem is how your brain responds to sudden volatility. The first trap is what I call the speed illusion. When price starts moving fast, you feel like you must act fast. You believe the opportunity disappears if you don't click immediately. But speed without structure is panic disguised as decisiveness. The second trap is the prediction obsession. You convince yourself that if you just analyze the data enough, you can forecast the outcome before it's released. You try to be right about the number instead of being prepared for the reaction. The third trap is adrenaline addiction. Volatility feels exciting. Heart rate rises, hands tense. You feel alive. That emotional rush tricks you into thinking you're being productive, when in reality, you're being reactive. Most traders don't lose during news because the market is random. They lose because volatility exposes emotional weakness instantly. And if you don't have structure before the release will control you. Part 3. Why news trading feels like luck. If you've ever watched a news candle explode 30, 40, 50 pips in seconds and thought, there's no way to trade that consistently, you're not alone. News trading feels like luck because it magnifies everything you already struggle with. It doesn't create new weaknesses. It exposes the ones that were always there. Volatility is just a spotlight, and when that spotlight turns on, most traders freeze or overreact. The first deeper issue is outcome obsession under pressure. During normal market conditions, you might manage your emotions reasonably well. But when the number drops and price starts flying, your mind jumps straight to profit. If I catch this move, that's my week sorted. You stop thinking about process. You stop thinking about risk. All you see is potential reward. That shift in focus is subtle but destructive. The moment you trade for the spike instead of trading your plan, you're gambling. And gambling feels like luck because sometimes you win big and sometimes you lose big, with no stability in between. The second issue is over-leveraging. News traders often increase their lot size because volatility is higher. It sounds logical. Bigger move, bigger profit. But volatility cuts both ways. Wider spreads, faster reversals, slippage. If your position size doesn't adjust for that reality, your risk multiplies without you realizing it. Then, one aggressive spike wipes out multiple controlled days. It's not bad luck. It's mismanaged exposure during unstable conditions. The third issue is lack of predefined scenarios. Most traders go into news events with hope instead of structure. They hope the number aligns with their bias. They hope price continues in one clean direction. But hope is not a plan. Structured traders do something different. Before the release, they define two possibilities. If price breaks and holds above a certain level, this is the bullish scenario. If it rejects and closes below another level, this is the bearish scenario. No guessing, no forecasting the headline, just reacting to behavior once the market shows its hand. The fourth issue is emotional compression. News compresses time. Moves that normally take hours happen in seconds. Your brain struggles to process that speed. You feel behind even when you're not. You feel like everyone else is making money except you. That urgency pushes you into trades you would never take during normal hours. And again, when results swing wildly, you call it luck. But the common factor isn't randomness. It's your reaction to compression. The final issue is inconsistency in measurement. After a news loss, traders say, I shouldn't trade news. After a win, they say, news trading is amazing. They evaluate based on one event instead of a series. Structured traders measure differently. They track execution across multiple releases. Did I follow my plan? Did I respect my levels? Did I size correctly for volatility? Over 10, 20, 30 news events, patterns emerge. Edge becomes visible. Luck fades as an explanation. Now here's the shift. News trading stops feeling like luck when you stop trying to win the spike and start structuring around volatility. Instead of predicting the number, you trade the reaction. Instead of increasing size for excitement, you reduce size for stability. Instead of entering before the release, you wait for confirmation after structure forms. Instead of measuring success by catching the entire move, you measure success by clean execution. Structured traders don't need to catch the first candle. They don't need the full range. They don't need the perfect entry. They need defined risk, predefined zones, and consistent behavior. That's it. When you approach news this way, the chaos becomes organized, not because volatility disappears, but because your behavior stabilizes. And once your behavior stabilizes, the results start to stabilize too. Part 4. It was never luck. There was a trader I once spoke to who avoided news completely. Every time a red folder event appeared on the calendar, he closed his charts. He told himself it was smart risk management. In reality, he was afraid. Months earlier, he had tried to trade CPI with oversized positions. One violent spike slipped his stop, and just like that, half his account was gone. From that day on, he labeled news trading as dangerous and random. But what he really experienced wasn't randomness. It was unstructured exposure. Eventually, he decided to approach it differently. Not with bigger size, not with predictions, but with structure. He started by reducing his position size by half during major releases. He marked key levels from higher timeframes before the event. He wrote down 2 clear scenarios. If price held above this zone after the release, he would look for continuation. If it rejected and closed below that level, he would look for pullbacks into resistance. No guessing the number. No entering before confirmation. Just reacting to behavior once the dust settled. The first few events were uncomfortable. Waiting felt wrong. Watching the initial spike without jumping in felt like missing out. But over time, something changed. His trades became cleaner. Losses were smaller. Wins were controlled, not explosive. He stopped chasing the entire move and focused on taking a logical portion of it. After several months, his results during news were no longer dramatic. They were steady. And that steadiness is what proved the point. It was never luck. It was structure. This is where the real shift happens. News trading separates gamblers from professionals faster than almost any other environment. The gambler sees volatility and thinks opportunity. The professional sees volatility and thinks preparation. The gambler wants excitement. The professional wants clarity. The gambler tells stories about catching massive spikes. The professional tracks execution across 20 releases and looks for consistency. When you approach news like a casino, your results will feel like a casino. Big highs, sharp lows, no stability. But when you approach it as a scheduled volatility event with predefined behavior, something changes internally. You stop needing to be right about the number. You stop chasing the first candle. You stop increasing size just to make the move worth it. You become a trader who executes rules under pressure. And that identity shift is everything. Once you see yourself as someone who prepares instead of predicts, volatility no longer intimidates you. It becomes another condition to adapt to, just like low liquidity sessions, just like trending markets, just like ranging markets. News is not special. It's just faster. And faster markets don't require emotion. They require discipline. Here's the sobering truth. Structured news trading is not glamorous. It's not about doubling an account in one morning. It's often about taking smaller, controlled trades while others are swinging for the fences. It's about accepting that spreads widen. It's about accepting that you won't catch the entire move. It's about being comfortable sitting out if structure doesn't form. If that sounds boring, good. Boring is stable. Stable is repeatable. Repeatable is profitable. So the next time someone says trading the news is pure luck, ask yourself a better question. Was it luck or was it lack of structure? Same release time, same data, same volatility. The only variable is behavior. You can keep blaming the spike. You can keep chasing the candle. Or you can prepare, define risk, wait for structure, and execute calmly. News trading doesn't have to prove that markets are random. It can prove that your discipline works under pressure. And if you want to keep sharpening that discipline, keep following the channel as we share more other insights, trading stories, and trading motivation tips on the future videos.